So I would like to welcome everybody to the Westside Meetup Kapolei annual monthly meetup, which is now on Zoom. I'd like to start off by thanking everybody for coming. As you know, as those who know me at least, know that I believe that our time is our greatest asset, and you decided to spend that asset here with us today, so thank you. If people don't know me or have never been here before, my name is Jasmine Kallio. My husband, CJ Kallio, and I have a company called WNN Properties. We are out-of-state buy and hold investors. We build portfolios of cash flowing investment properties for ourselves and our investors. We started this meetup about 5 years ago. And we have been doing this because we had to drive really far into town, which driving is not an issue at the moment. And it was like a 3-hour network meeting where one person stood in front and talked until 10 o'clock at night, and then networking began and I had to go home. So then we said, let's build a meetup in our side of the island, the west side, and we wanted to base it on mostly networking. So with that understanding, we always like to do a speaker speaks, we do a question and answer, and then we just network. And we're not supposed to be over an hour. We just mostly just try to network. As you know, doing this online is a little bit harder. It's a little bit more difficult to do the networking, but we still want to connect. We still want to give you education, and we still want to keep up with each other. And hopefully we get to have a few networking or at least be able to contact you outside of the Zoom as well. But with that in mind, we do have our guest speaker, and I'm going to read off his paper here. His name is Jason. He was raised in Kailua and graduated at Punahou. He has been helping real estate investors with tax preparation and tax strategies for over 20 years. Some of the areas he has worked with is our multi-member LLCs, 1031 exchange, installment sales, out-of-state and out-of-country investment properties. His clients include real estate investors, property managers, property management companies, and hard money lenders. Jason holds bachelor's degrees in finance, in minors in accounting and economics, and he's licensed as an enrolled agent with the IRS, allowing him to prepare tax returns anywhere in the US. So with that, I would like to welcome Jason.
Thanks, Jasmine, and thank you, CJ, for having me again at one of your meetups. Just let me know if you can't hear me or if we need to make any changes. Welcome, everyone. Thank you for your time. I hope that I will be able to give you something of value in the short time that we have together. And I will try to be as brief as possible. And a little disclaimer before we start. This is, I'm going to give some general tax advice. This is not specific to your situation. If you would like something specific to your situation, I would suggest you look for a tax advisor. Having said that, what's on the agenda today are basically things that everyone that is considering investing in real estate should think about or needs to think about. The agenda, I'm going to have 3 topics. The first topic is different types of professionals. These are going to be the different professionals that you'll probably come across if you haven't already. Centering around the tax and bookkeeping space. The second agenda item is tax advantages of real estate. And the third agenda item is bookkeeping or record keeping for real estate properties. So I'm going to jump right into the first one. And it's going to be the different types of professionals. The first professional I'm going to start with is a tax advisor. So some people like to do their own taxes, but as you will find, once you start getting into real estate, particularly when you have multiple properties and properties that are out of state, you'll probably want to have a tax professional in your corner. And there are two main tax professionals that I would recommend to anybody. One is the CPA. I think we're all pretty much familiar with that designation. And the second one is someone like myself, an enrolled agent. And I'm just going to briefly talk about the differences between the two. The CPA is a state certification. It's a state license. They have to go through a test. It's a very hard test. It covers law, accounting, audit, not IRS audit, but accounting audit, meaning generally accepted accounting principles. And it covers tax. So it covers those 4 areas. They need to be certified. A CPA needs to be certified in the state that they practice. So if someone practices in Hawaii, they have to be certified in Hawaii. They can cover all types of taxes: personal taxes, partnerships, trusts, payroll taxes, corporations, you name it. They can also represent you in front of the IRS. So if you're going through an IRS audit, they can sit with you and go through that audit with you and help you. An enrolled agent, so that is a CPA. An enrolled agent is an IRS license. It's the highest IRS license. And there's a test as well. It's a 2-day test. It covers individual taxes, entities, partnerships, meaning partnerships, trusts, estates, corporations, payroll tax as well. And another part of the test is policy and procedures. And the test is exclusively focused on tax. And once you get an EA license, or when someone has an EA license, they can practice anywhere. It's a federal license, meaning that I can practice in Hawaii, but if I want to go practice in New York, I can go to New York and practice and not have to take any more tests within New York. Let's see. They can also, an enrolled agent can also, like a CPA, represent you in front of the IRS. Basically, in terms of the IRS's eyes, a CPA and an enrolled agent are the same. They have the same responsibilities and the same powers in general. Who should you choose when you're looking for a tax advisor, a CPA or an EA? To me, it doesn't really matter. Either is great. There are some CPAs that don't work in taxes. Some of them just work in audit. Some of them just work in accounting. A lot of them work in tax. So if you go to a tax professional and they have CPA by their name, and they're advertising themselves as a tax professional, they're probably well-versed in taxes. What I would do, whether it's a CPA or an enrolled agent, when looking for a tax professional to work with, if you don't have one already, if you have one, that's great. If you're comfortable with them, that's great. But if you don't have one, and if you're looking for one, there are a few things to think about. The tax preparation, that's key. That's a given. Tax planning, do they do any after tax season planning for you? If you have, let's say, 10, 15 properties, and you buy and sell throughout the year, you might need to do some tax planning, maybe in the summer, maybe in the fall. I would ask the tax professional, the tax advisor, do you do that? Do you incorporate that in your services? I'd also see if they're a good listener, if they're a good coach, because as you expand your real estate portfolio and expand the complexity of the transactions that you do, I believe you're going to have to find someone that's going to help you and coach you along, because you're going to have questions, and you want someone who's going to listen and is not going to be afraid of sharing information. to make you a better real estate investor. And I'd also ask them if they worked with real estate investors before. I'm sure they have. Are they familiar with 1031 exchanges? Do they have any clients with real estate property in other states? So those are the two main tax professionals I would advise going to, either a CPA or an enrolled agent. I'm going to switch gears a little to the bookkeeping side. And there, when you start out, and we're going to touch on this a little bit in the third topic, when you start out, the bookkeeping is probably going to be fairly easy if you have one property. You can basically do it on a piece of paper, an Excel spreadsheet. But as it gets more complex, as you add more properties to your portfolio, it might behoove you at some time to get the services of a bookkeeper or an accountant. And so I'd like to tell you the differences between the two. Bookkeeper does basic entries. So bank account entries, things that you'd find on a credit card statement, things like that. An accountant understands double entry bookkeeping, which is kind of the basis of accounting. I don't expect you to understand that term, double entry, just that they should. They do complex journal entries, and they've probably gone to class and gotten some kind of degree in accounting. They often oversee and review a bookkeeper's work. So if there's a complex, the bookkeeper might do, so maybe trying to think of an example here. One of my clients has a bookkeeper and they do the basic entries for the properties. So they have one bank account for their, let's say 10 properties, and they enter the revenue coming in and pay the expenses, and they have a credit card. But what happens if a property gets sold or there's an installment sale or something of that nature? That's when I come in and maybe make a little more complex entry in the bookkeeping system. So there are differences between a bookkeeper and an accountant. An accountant is kind of a general term, and a CPA, I would say, is definitely accountant, but not all accountants are CPAs. Not all enrolled agents know accounting, because enrolled agents, having an enrolled agent license is just specific on tax. If someone says, I'm a tax accountant, they could be a CPA that also does tax. They could be an enrolled agent like myself who does tax but also understands in accounting. So that is kind of a general overview on accounting, bookkeeping, some of the other professionals that you might come across as you expand your portfolio. So that's the end of agenda 1 item. We're going on to the second one. The second one is tax advantages of real estate. So why own real estate? I'm sure Jasmine and CJ have talked about this before, and I'm going to talk about it kind of from a tax standpoint. So the two main advantages are the income, the cash flow that you get, and the appreciation in the property. The property grows in value. I'm going to tackle the income or the cash flow first. So a tax advantage of investing in real estate is, number one, there's no self-employment tax, unlike a business. What's self-employment tax? It's basically the Social Security and Medicare portion that you'd have to pay if you were an employee. If you were a business owner, you'd have to pay that, and they call it self-employment tax. Well, the income that you receive from real estate, from a rental, is what they call passive income, and that means it's not subject to self-employment tax. It is not a business. It's not an actively run business in the IRS's eyes. And self-employment tax basically amounts to about 15%. So if you, let's say you have a business, and I'm generalizing here, let's say you have a business and your net income is just say, let's say $10,000. You're going to get hit with 15% self-employment tax, as opposed to if you have real estate and your net income is $10,000, you won't get hit with the 15% self-employment tax. The second great thing about income-wise in terms of real estate income is depreciation. Depreciation protects some of your income from tax. How does that happen? Well, let's just say you have $10,000 in a year on your rental property, you have $10,000 of revenue. So $10,000 of rents coming in. Your cash out-of-pocket expenses is $6,000. So that includes the mortgage interest, the real estate taxes, everything, repairs, whatnot. So your cash eyes is not the taxable income. Because now let's say we have $2,000 of depreciation. So the depreciation is an expense, but it's not a cash flow item. You don't have to pay any money for the depreciation. So what you would do, or what I would do as a tax professional on your tax return, is the tax software takes the $4,000, let's say, of cash flow, and it subtracts out, let's call our depreciation $2,000. So it subtracts out the $2,000. Now we only have $2,000 of taxable income. And that $2,000 of depreciation protected some of the cash flow from getting taxed. So even though our cash flow is $4,000 of the year, the IRS only considers $2,000 of it as taxable income. So we only get taxed on $2,000. That's fantastic. That's one of the best things about real estate, owning real estate as a income producing item. So that's kind of on the income side. Now I'd like to talk about the appreciation side, or the growth in value. So your property is growing in value throughout the years. And let's say you bought a property and in 10 years, let's just say it doubled in 10 years. It was a hot market. And it went from, let's just say, 200,000 to 400,000. So you have a $200,000 capital gain, but you want to sell that property and buy another property, but you don't want to pay the tax on the $200,000. So in the IRS law, there's a section called 1031. And you might want to just keep that in the back of your brain, because people will talk about it. They refer to it as 1031 exchange. 1031 exchange basically says, I'm going to take the property that increased in value, my $400,000 property that I have a $200,000 capital gain on, and I'm going to exchange that piece of property for another piece of property. And you can do that, and you won't have to pay tax on the $200,000 gain, because you're exchanging like for like, one piece of property for another piece of property. Now there's special rules for this, and what they call a qualified third-party intermediary needs to be involved. But if you work with a broker, you just mention, I want to do a 1031 exchange, and they should be able to set you up with someone that can facilitate that. And there are rules involved. I don't want to get into them unless someone has a specific question. It gets a little detailed, but for now, just know that if you sell, I'm sorry, $200,000 is they call it tax deferred. It's basically just sits in that property that you bought, and you won't get taxed on it. So that's one tax advantage on the appreciation side. Another tax advantage is installment sales. This is also called seller financing. So let's say you want to, again, you want to sell that property, but you don't want to buy another property. You just want to take the cash, but you don't want to pay a whole lot of capital gains right off the bat. So what you can do is take a note. You're basically the bank. That's what it comes down to. The buyer gives you a down payment, and then you set up a note with them with interest, and they pay you just like they're paying a bank. Let's use our example, the $200,000 gain on the $400,000 piece of property. Let's say you sell that, and let's say they take a note over, let's say 20 years. That $200,000 gets spread over those 20 years. So you don't get hit with it all at once. There's another upside to that, seller financing or installment sales, is that if they default, heaven forbid, no one wants to go through a default, but just in case they default, depending on the state, because there are rules, you can take the property back. Let's say, so 1031 exchange and installment sales, two tax advantages of property that's appreciated, protecting yourself from capital gains tax in a property, in a real estate investment property. So I'd also like to say, for 1031 exchanges, we could go on and on. We could probably spend an hour on 1031 exchanges, but there's one other thing I'd like to mention about them. You can sell multiple properties, or you can sell one property and go into multiple properties or one property. And it could be anywhere in the United States. So if you wanted to do a 1031 exchange from a property here in Hawaii and buy, let's say, 2 or 3 properties in Kansas, then you can certainly do that. And it'd be considered a 1031 exchange. So let's go on to bookkeeping options. So this is the third agenda item. I know I'm going really fast, but I'm sure you guys will have questions for me. I appreciate your patience. This is my first, this is not my first webinar that I've been a part of, but this is the first webinar I've been a presenter. So this is all new to me. So thanks for your patience, appreciate it. Let's see, so bookkeeping options. So as you expand your real estate portfolio, you're going to find that the bookkeeping is going to take more and more time. So you want to have a strategy going in on how to facilitate this and facilitate the bookkeeping in an effective manner. So what are we talking about when we talk about the bookkeeping? So the main things are the rents received, and this is, let me back up a minute. As a tax advisor, I want to see, or any tax advisor, when they want to do your taxes, they want to see a profit and loss or an income statement. What is that? It's really basic. What are the rents received? And then itemized, what are the expenses that you've had to pay? So I'm going to run through a list. This is a not exhaustive list, but this is just a list as an example. So number one, rents received. That's the rent that you took in. Then some ordinary and necessary expenses, insurance, repairs, property management fees, yard maintenance, pool maintenance, property taxes, general excise tax if you live here in Hawaii, transit and accommodation tax if you live here in Hawaii, and it's a vacation rental, mortgage interest, travel can be a percent of your tax preparation fees, conservative number. I put my tax prep fees in my clients' profit and losses when I do their tax returns. Let's see what else. Oh, the last one is homeowners association fees. There is a limitless list of other items, but you get the idea. Essentially, your tax professional needs to see for each property, a list containing those items that apply for each property. So how are you going to do that? Well, if you have one piece of property, it's pretty easy. You can just whip out your pen or paper, pencil, or paper, and start writing stuff down. But if you have, 10, 15, 20, even 5, it could be a little time consuming. So what I would suggest is spreadsheets. If you're not familiar with Excel, it is a great tool. Maybe take some classes. Most of you, I think, are probably familiar, at least at a basic level. I'm sure Jasmine and CJ have suggestions on spreadsheets. I have one that I found. It's a template. It's all one word. Timesavingtemplates.com. Timesavingtemplates.com. They offer a wide range of Excel spreadsheet templates. Some of them are pretty good for real estate investors, so check them out. I have no affiliation with them. I just found them one day while I was scouring the internet. They're probably $5 to $20. I'm not sure, but it's definitely economical. So I would say as your portfolio grows, have a system, keeping track of all the paper that you're going to get. I would use a document scanner and scan a lot of these things to PDF. I do that for my work anyway, and I generate a lot of work, a lot of paperwork, as you could imagine, and you will too if you have a big portfolio of properties. So we got pen and paper, we got spreadsheets. The third one is an accounting software, and I'm going to QuickBooks is the big 800-pound gorilla out there. There are others, accounting softwares, but QuickBooks does a fairly good job. They have, within QuickBooks, you can actually create properties. They actually have a function called properties. So you could, when you're entering in, you or a bookkeeper or someone entering in the transaction, you can code the transaction to each property. So when you go and print out a profit and loss, you will actually have, let's say you have 3 properties, you'll have one column for one property, one column for one property, and one column for another property, with all the items necessary for your tax professional to input it in his or her tax software. And for your viewing, because you need to know if a property is making money or not, right? If you got a minus $5,000 at the end of the year for one property, it might be a good way. It might be a good thing to have a accounting software so you can identify what caused that $5,000. Was it too much repairs or not enough rent or whatnot? Let's see, that is all I had. I tried to make it quick, but I'm sure you have a lot of questions.
Yeah, thank you. That's very helpful. We did have quite a few questions. One of the questions that came in, it seems like there's a lot of 1031 exchange questions. Just to make sure everybody knows, there's a 1031 exchange mediator that would be more of an expert on explaining all of those types of things, and we don't want to, he has knowledge of those, but I don't want to just throw it on. This is his expertise, for Jason, just to give a little bit of a disclaimer. But here are the questions that came in. Can you do a 1031 exchange to sell property in a state for a like property in a different state, or a 1031 exchange to purchase more than one like property? Example, 2 single family, 2 condos, etc.
Yes, absolutely. And you can even do the property, it's basically real estate for real estate. So you can take a piece of land and exchange it for an apartment building. You can take an apartment building, exchange it for a piece of land, or take 3 pieces of land and exchange it for 5 industrial buildings. It's very broad. And it basically encompasses all real estate, anything that's considered real estate. And the thing about, and thank you, Jasmine, for the disclaimer. The thing about the 1031 exchange, it is, when you go through a 1031 exchange, there's the actual mechanics of it on the qualified intermediary side, and also the tax part of it, which is on my side, because there are specific tax forms that we have to fill out in the tax return. So it's kind of a dance between the both of us, but most 1031 exchanges happen pretty smoothly for the most part.
Great. Well, thank you, Jan, for that question. Brad asks, if I 1031 exchange into multiple properties, say 2 properties, can you specify what amount goes to each? So an example of 200K, split that into 150 and 50. Also, that amount can only be used for down payment or not rehab costs?
Amount. So normally, if you need to put more money in, you can. It's normally the down payment, meaning equity. So you're basically taking the equity that you have in one property and putting it over into another. The key here, and yes, you can split it up. And in terms of the tax, tax-wise, we split it up on my end in terms of like the depreciation and the basis and all that. The key in a 1031 exchange is you don't want to have any money out, no money out at all. So you don't want to get a check for anything. That's considered, they call it, the technical terms, boot. And that, whatever money, let's say you do a 1031 exchange and you get $10,000 in the mail and from the escrow company, and you weren't expecting it, I would turn around, call the qualified mediator, call them and give them the check back, give the check back. And another thing with 1031 exchanges, you want to make sure the value. So if you're selling a $600,000 property, you're getting or buying either a $600,000 property or $600,000 worth of property or more. So it could be $200,000-$300,000 properties. I don't know if I answered his question or not, but.
Yeah, I think he would just want to know if you can split, if it has to be evenly between any properties that you identify.
No.
Great. Okay, Cedric asks, I plan to sell 4 properties to 1031 into 1 commercial. The clock starts to ID the replacement properties at the closing of the first of the 4 or the last of the 4 declared. FYI, audio quality and my end changes. Okay.
Oh, that's a good question. I would say off the top of my head, that I think it's the first. I'd have to look in the rules, to be honest. I don't know that off the top of my head.
Great. I believe it's the first 2.
Because
Can you,
then, sorry, because I always try and flip it. I was like, what would the IRS want, right? They wouldn't want the latest one. They want the first one, right? Because the clock starts earlier. So I would say the first one for sure.
thank you. Okay, Jan asks, can you also discuss about LLC formation for REIs?
Okay. Uh, Ooh, that's a whole nother, Jasmine and CJ, that's a whole nother hour. Yeah, here's the basics on LLCs, and I'll leave the asset protection stuff to the lawyer because I know you're going to have a lawyer. I don't want to steal any of his fire. But from a tax standpoint, um, if you have an LLC and it's got two members, even if it's a husband and wife, it's a partnership, and you need to have a partnership or a corporation, and you need to have a separate entity. So if you want to keep everything simple in terms of a tax wise, and have the protection of the LLC, but have it in your tax return and not create a whole nother tax return, meaning partnership or corporation, have one owner on the LLC. That would be my number one thing for formation.
Yes, I learned that lesson, several $100 lesson right there. Let's see, Brad asks, do I need to complete a 1031 exchange within the same calendar year, assuming tax preparation challenges?
Nope. No, you don't. It could be, so if you sell in December and buy in January, you actually have to do the 1031 exchange in, let's say you sold in December 2019 and bought in 2020, the 1031 exchange happens on your 2020 tax return, the
Okay,
year that the exchange finishes.
great. Okay,
You miss
Jan,
Katie.
I miss Katie.
Yeah.
Let's see. Is 1031 exchange specifically for investment properties, or can it be for a primary resident?
Oh, it's a good question. That comes up at least once a year. This is just investment properties, just investment properties. Now, there's gray areas there, and some people get really aggressive. Some people have personal residence, and then they're like they rent it out, and they think if they rent it out for 6 months, and then they're like, okay, we want to sell it and do a 1031 exchange. I think that's pretty aggressive. Normally, the IRS wants 2 years to wait 2 years. So let's say you have your principal residence, you turned it into a rental. I'd wait 2 years, have it a rental 2 years, and then do a 1031 exchange. Yeah.
Well, on that question, so what if you had a part of your house as a rental?
Yeah, I don't think you can do that. I'd have to go in the rules, but I don't think so. The cool part of the principal residence rule, though, is you get, if you're single, you have the $250,000 exclusion. If you're married, you have $500,000 of exclusion. So most people don't even think about that when it comes to selling their principal residence.
Great. Let's see, Jan asks, LLC formation and purchasing properties out of state. Would you also need to form an LLC's foreign entity in the state that the house is purchased?
My experience is if you form the LLC, like say in Hawaii, and you want to buy a property in, I don't know, Nevada or Kansas, I think, depending on their state law, I believe you got to file as a foreign LLC, a Hawaii LLC doing business doing business technically in that state. That's my understanding.
Great. Go ahead, CJ.
Yeah, I think that LLC question would be great when we have our speak. He'd be able to touch on that a little bit more clearly. Okay, Jason, I know I see a lot of people on here that are out-of-state investors similar to us, and I get asked this question often regarding taxes. What is considered a travel write-off? So if they want to go and view their property, and how much of that trip, if it is write-off, how much of it is deductible as a write-off?
That's a good question. So I'll touch on two points. One is if you're going on a property search, let's say you don't have a property in Kansas, but you want to go look in Kansas, and you fly out there and you spend all this money, keep those receipts or keep a tab of your costs. That cost is going to go into the purchase of the building. But now let's say you purchase some buildings in Kansas, and the next year you want to fly out there. You know, normally it's you have to this is another gray area, so I try to be conservative with this. Generally, if you're there to view the property or make repairs or organize for repairs, and that's the majority of your time, then you can take all of it. The whole thing, 50% for meals. Meals are always 50% deductible if they're ordinary and necessary. But let's just say, you know, let's say you have 3 properties and there's no other reason why you're in Kansas. You go over there for 3 days and you fly back. I would say that's okay for the whole thing. But let's say you got some property in, I'm going to pick Destin, Florida, because that's where my aunt and uncle live. But you make a side trip to Orlando because you want to go to Disney World, take the kids to Disney World. And you spent 3 days at Destin viewing your properties and doing what you need to do. And you spent 10 days in Orlando. Yeah, you can see where I'm going with this one. You take a portion. You take a portion that's reasonable. You know, if you had, 10 days for the whole trip, let's say, for the whole thing, the Destin and the Orlando, then 30%, something that's reasonable and justifiable.
Yeah, it sounds like being honest is the best bet.
Yeah. I mean, you don't want to have, let's see, family in Destin, and you're going there 5 times a year, and you also have property in Destin, and then you put in, maybe $15,000 of travel expenses on your 3 properties. That might be a red flag for the IRS. You want to do what's right. You want to do what's reasonable, a reasonable approach.
Great. Neil asks, can I ask your ballpark fees for accounting services, and are you taking new clients?
I am taking new clients. Everything's customized, so it just depends on what you got. I will say this. Everybody that's under me has 3 things. They have tax preparation, they have tax planning, and unlimited phone and email support year-round included in my fees. And my services are customizable, so are my fees. So I can't really ballpark them.
Well, as long as we are on these fees and ballparking it, when should an investor move from doing it themselves to finding a bookkeeper, then to moving to an accountant, and then to getting a CPA or all the steps towards all of that?
Sure. It's a good question. It's hard. Everyone's different. We want to save as much money as we can, and we want to do as much as we can by ourselves. I understand that. When you start getting overwhelmed, I think that's key. The thing is with people, with some people, they want to save money and they want to do it themselves, and they enjoy the learning process, and I appreciate that. Absolutely. I'm the same way. But there comes a point when someone is paying head against the wall and using up so much time just trying to maybe prepare their own tax return, where they could have that burden, pay someone to lift that burden off their shoulders so they can use all that energy and time for growing their portfolio. So when your head starts to hurt from banging it against the wall too much, that's probably a good time to start thinking about getting some help.
Great. Alan asks, do I need to file taxes and in the state my out-of-state rentals are?
That's a great question. Yes, you do, because if you sell the property, you're going to have to file the tax return. And the reason you do it now is to establish, number one, if you have any taxable income, you have to report that. And number two, if you have any loss, and normally if you buy a property, normally you create the depreciation creates a loss, kind of what we talked about in one of the agenda items. So to build up the loss in that state, which is called net operating loss, let's say you have property in Kansas and you've had a loss, depreciation has caused a loss for the last 5 years, and it was about $2,000 a year. So you got $10,000 of net operating loss in that state. And you have to, when you file the returns, that's how you tell the state that, hey, I have this net operating loss. And then let's say you go and sell that property, okay, that net operating loss will decrease the gain that you have, or if you have a gain, it'll decrease the gain in that state. But you have to file the tax returns in order to get the loss. And then, again, if you have income, you have to file the tax return to report the income.
And to be clear, you're able to file those returns out of state. You don't have to find a local person there in the state.
No, an enrolled agent and a CPA can file those returns. Yeah, absolutely. Yes, I can. Yeah.
Logan asks, what if you 1031 into an investment property and after some time you move in and it becomes your primary residence? Will the recapture depreciation go away?
That's the recapture depreciation. No, it's still there. Move in depends on how much time. I guess the recapture depreciation. You know, I'd have to look into the rules because there are specific rules on that. So basically, you have a rental property, you move into it, you've depreciated it, and now if you keep it forever and your kids inherit it, then you don't have a problem. But if you wait a year and sell it, you're not going to have the let's say your $250,000 capital gain exclusion. If you do sell it in outside of 2 years, so wait 2 years and then sell it, you have the $250,000 capital gain exclusion. I have to research to see if the recapture is a problem. I'm not sure on that off the top of my head. That's a good question.
Great. Thank you. Alan asks, what are typical IRS red flags on investment properties?
That's a great question. Having travel expenses of like $15,000 when you're, visiting the relatives 5 times a year in Kansas, stuff like that. Having a real estate that loses money consistently for years, that's a huge red flag, because then they're saying that you're not reporting all the income, all the rents. And I've seen that, and that's a huge, because then the IRS says, well, why would you lose money on this property every year for 10 years. You know, if they're losing $5,000 a year in the property for 10 years, why would anybody do that? It makes no sense. And one more thing, and this is for all tax returns, nice round numbers. People prepare their tax returns and think the IRS doesn't look at the numbers. Like if you put, you know, insurance, $1,000, mortgage interest, $5,000, nice round numbers, that's a huge red flag.
Okay. Casey asked, do you charge hourly fees or set fees for pages filed?
I don't charge hourly unless it's a very specific project, but I charge a fixed fee. What I do is I look at your tax needs, and I'll come up with a fixed price, and I come up with that price for two things: on complexity and consistency. So let's say you start off with a rental here in Hawaii, your home here, and that you live in and own, and 3 properties in Kansas. So there's 2 state returns and maybe a Schedule A for itemized deductions. We'll start there. And then if, let's say, a few years later, now you decide to buy 3 other properties, and then I'll revisit the fee structure again, because we're adding a little more complexity to the return. But if there's one-offs, let's say you do a 1031 exchange from one property. You have 3 properties in Kansas. You do one property, you exchange one property in Kansas for another property in Kansas. It's a 1031 exchange. The return my fees wouldn't increase anymore, because that's a one-off item. So I hope that, so complexity and consistency. If the complexity goes up over a long period of time, then we'd have to revisit the fees. I hope that helps.
Great, thank you. Brad asks, since you are an EA, do you accept clients out of Hawaii?
Yes, I have at least 10 clients that are outside of Hawaii. Yes.
Awesome. And CJ has a question.
Okay, so being that we're in Hawaii and property values are so high, I just got asked this the other day. So what's the tax implications about when you're inheriting a property from a death? And what are, I guess the tax implications would be the simplest form.
Yeah, that's a great question. This is going to be general, very general. Basically, if someone let's just make it really easy. Their last parent dies and they're getting the property. Let's say they didn't have any brothers or sisters. They're the only child. They're getting one property, and the parents bought it way back in, I don't know, 55 for $50,000, right? Now it's worth $1 million, right? You pay no tax at all. And let's say you get the property and you turn it into a rental, your depreciation or the rental's value, because some of it's got to go to land, but some of the value has to go to land, but the value of that property is now to you $1 million. So let's say the house is on there, and the house, the appraisal comes in with the house being $300,000. You get to depreciate that property with a $300,000 base. It's inherited property is one of the best tax advantages ever.
So would you say, knowing that someone might be on their last legs, it would be a mistake tax-wise for them to transfer title over to the child?
In terms of tax, absolutely.
Yes.
Absolutely. Keep it.
Great. We only have 3 more minutes, so I have 2 last questions, and then we're going to start wrapping it up. Young asks, I believe you mentioned that you add your fee as an expense to the tax preparation. Would all of those expenses be deducted or a portion of it?
To be honest, I get a little aggressive because it's not a whole lot. In the big scheme of things, it's not a whole lot. When the IRS goes after someone, they want to make sure it's worth their while too. So I would say a good portion. And in fact, all my clients are real estate investors or business owners. So the reason they're coming to me is because of their real estate and business holdings. So I get pretty aggressive with that.
Great. And final question, Cedric asks, typically all proceeds boots needs to go into replacement property. Can we add a clause such as a $25,000 to be held in escrow by an escrow officer and released to a project manager on closing to be used to repair the roof or etc.? Or is it is that a red flag?
Oh, is this a 1031 exchange? Is
Yes.
that in the 1031 exchange? So I'm sorry, you're adding 25 grand in there? Or
I think he wants to sell the property, have the exchanger hold 25,000 in order to do repairs to the property he purchased.
you know what? I think I'm recalling something in the depths of my mind that I had to look up maybe 2 years ago, saying that is possible, but I think there's a small time frame in there where you actually have to get that going and have it repaired. It might be before the 180 days is up. I'm not sure. That's a great question, but I know I had to research it. And I think it's somewhere in my notes.
Okay, great. So we only have, I lied. I had one more question. So how can anybody reach you if they wanted to get more information about your company?
You guys have my email, right?
Yes.
Yep. And so, well, I'll just give it out. That's probably quicker. Sorry. It's JASON at Honsu Advisors, HOSU advisors.com. Advisors with an O.
Thank you. And for our closing, we will have CJ wrap this up and let you know when our next meetup is and how to contact us.
Great. Thanks, everybody.
Great.
I appreciate it.
Thank you, Jason. Always a wealth of knowledge when you're on. Look forward to being able to have this in person again.
Yeah.
Well,
thanks.
Thank you, everybody, for joining us tonight on our virtual meetup. We appreciate you guys accommodating us with this unforeseeable and uncontrollable situation, having to be virtual. We are simply adapting, and we're trying to make this an enjoyable experience similar to the type that we have in person. Our meetups are held every last Wednesday of every month. It's at 6 p.m. We tend to send out a reminder the week prior, so the Wednesday prior to the meetup, with the topic, the speaker, and the Zoom link. We foresee this being the upcoming next 2 or 3 meetups will be virtual before we're able to go back to in person. And this is, again, all pending what they release and the restrictions and requirements that we have to follow. So if you aren't already on our email list, if you don't mind getting into the chat and private messaging Jasmine, we do not spam. All we do is send out the reminder the week before and the day of with the Zoom link. Every last Wednesday of every month, 6 p.m. Once we begin to meet in person, we've been shown interest to keep this virtual meeting. We are entertaining going to a virtual and in-person meeting every month. We have yet to set the commitment to it and date and time, but just keep that in mind that we are trying to keep this platform, since it is reaching a farther scope than just the pure West Side investing people that we've been networking with. Next month's meeting, we'll be able to chat with you and send out the in reference to that. We also are on Facebook. If you need to look us up, you can hit up Jasmine in the chat. She'll give us the link to our Facebook page. Again, we appreciate everybody joining us. And if you want to stick around, we will stay on until the last person drops off. If anybody wants to network chat, and Jason, if you're available, if you want to stay on to answer questions, please do. If not, we appreciate you guys jumping on, and this will be the end of our recording. So thank you guys for tonight.